Okay, should have your cases back by now, so if you haven't got your case back, you need to send your case again. I don't know where it's gone. Your quiz is Wednesday, right? So you'll cover everything through the end of packet 2, though the last 20 or 30 pages in packet 2, there's really not a whole lot to do. It's really a case kind of revisited in the quiz, so I'll take pieces of your case and ask you, so if you're not familiar with your own case analyses, because somebody else in the group did the dirty work, you might want to do that. So let's finish up on investment analysis. So far we've talked about whether to take an investment, right? Look at the net present value. If it's greater than 0, accept the investment. If it's less than 0, reject the investment. And if everybody followed the rules, every investment should be a good one, right? I mean, I'm sure that even the worst investment on the face of the earth, there's some net present value analysis that somebody has done that showed a positive net present value. So today I want to mop up. So you've taken a project, let's say it's a 10-year project. It's 2 years into the project. And things are different from what you expected. They could be higher or lower. And it makes sense to actually look at existing projects. This is something you think companies do routinely, but it's amazing how companies, once they take a project, never go back and look at the numbers. There are 2 reasons for looking at the numbers. One is to kind of do a post-mortem. How good were we on our forecast? Not so much just to punish somebody or reward somebody, but to see if there's something wrong with the process. So we're going to talk about clues that you can get by looking at your past numbers. And this is not just about capital budgeting. This is something that you need to routinely do when you do valuation. When you project out numbers and the actual numbers come in, check to see the mistakes, whether there's something you can learn from the mistakes to make your process better. The other is even more critical. It's 2 years into a project, the numbers have come in. You have 8 more years left on this project, right? Your new forecast of cash flows might be different from your original because you've learned something over the first 2 years. In fact, almost always going to be different. You're saying, what am I going to do with those future cash flows? It might change what you do with the rest of the project. You might abandon the project, you might invest more in the project, you might continue the project. Every project, in a sense, has to get back in your portfolio every single year. It's got to justify itself. So enough, let's suppose you have a 10-year project. It's 2 years into the project. So the numbers that you see, the F0 through F10 were your original forecast. So think of this as your whole food dining case. Whole Foods has listened to, because most of you said accept the project. They've taken the project. It's 4 years in. The actual cash flows have come in. The actual cash flows, A0 and A1, can be different from your original cash flows. And the question is, what do we do with it? That's the post-mortem part, so the difference. Now there's going to be new forecasts of cash flows you make for the remaining 8 years, which can affect the choices you have on this project. Continue, abandon, expand, or sell to somebody else. So let's take the first part of the analysis. You do a valuation or capital budgeting. You project out your cash flows. The actual cash flows come in. They're almost, let me take the almost out, they're always going to be different from your forecasts. Part of the reason is chance. There's things you don't control, so the actual cash flows can come in different because of luck. The other is bias. What kind of bias? Well, people almost never forecast cash flows without an agenda. You ask a divisional manager to forecast cash flows for a project, he already has a decision he's made about whether to take the project or not. That bias feeds in. And by looking at your mistakes, the errors you make, the forecast errors, you can get a sense of which one dominates. If all you have are mistakes, if it's pure luck, here's what you should see. Your mistakes should cut in both directions. On some of your projects, the cash flow should come in greater than expected. Some they should come in lower than expected. That's the nature of mistakes. If you're biased though, the cash flows will always come in one direction. The actual cash flows, and this is almost always the case in capital budgeting, usually come in lower than your forecasted cash flows. It's a well-established finding when people go back and look at projects that people forecasting cash flows in projects tend to overestimate the cash flows. Decision makers have created their own kind of skewed mechanism for dealing with this. You know what they do? Especially there at the top, you get cash flow forecasts from below. What do? Knowing that there is a bias, you haircut the cash flows. You say, these guys tend to overestimate. It's a very, very, very strange and damaging process because it undercuts the whole point of cash flow forecasting if people are cutting and haircutting and reducing cash flows just because there's bias. But the only way you will see if there's bias is by consistently looking at the actual cash flows and comparing them to your forecasted cash flows. So the reason for the post-mortem is not just punishment and reward, though that could be an outcome. It's mostly to understand if there's bias in the process, and if there is bias, what to do about the bias. Because there are things you can do to reduce the bias. We talked about not looking at the past, right? The sunk cost issue. See if you can bring it in. But let's turn to the more interesting thing you find when you look at past cash flows. When you look at past cash flows, for instance, whole food dining, you might find that more people come into the restaurants or fewer people come to the restaurants than you expected. It wasn't that you were biased, you just did not know. Remember the Rio Disney theme park? We have no idea how that theme park will. So 2 years in or 3 years into a long-term project, based on the information you have, you forecast new cash flows in the project. And then you make a decision on this project. Here are the choices you have. If the cash flows that you are now projecting on this project have a net present value less than 0, the project has just collapsed, you can liquidate the project, shut it down. If you can sell it for greater than the present value of the cash flows, the present value of the cash flows is 200, but you can sell it to somebody else, or liquidate the assets, salvage the assets for 250, you're going to salvage it. If there's somebody out there who will pay you more than the present value of the cash flows, you will sell it. But if the present value of the cash flows is greater than 0, nobody out there will pay you more than what you computed, you continue. Every project, all 4 choices are on the table. So let's make this, let's take an example. I don't know whether any of you have been to Disneyland, but the original Disneyland in Anaheim had only one theme park, Magic Kingdom. And then about 20 years ago, Disney built California Adventure. The original idea was to build an amusement park with the California theme, and they were expecting about 60% of the people who went into Disneyland, because if you've ever gone to Anaheim, the theme parks are actually right across from each other. It's not like Orlando, you have to drive miles. You just walk across the middle and you're into and the original objective was that California Adventure would attract about 60%, that was the original expectation, of the people who went into Magic Kingdom. By 2008, Disney realized it had screwed up. It discovered that only 40% of the people who went to Magic Kingdom were crossing and coming into California Adventure. They had originally projected cash flows of $100 million a year on the theme park. They were coming in closer to $50 million. So in 2008, Disney faced a big choice with California Adventure. And here were the choices. One was to shut it down. When they built California Adventure, they built over the parking lots that were part of the original parking for Disneyland. They can just return it back to real estate, and it's very expensive real estate. It spreads out across. Let's say that the real estate values are $500 million if they shut down California Adventure. The second is to keep it going. It's not losing money. It's making $50 million a year, continued at $50 million a year. The third is to put more money into the theme park. In 2008, their estimate was about $600 million, kind of put in new things that might attract, because one of the problems with the original California Adventure was there were very few attractions for young kids. So they said, if we spend $600 million, put in more stuff, maybe more people will come in. And let's say in 2008, with the revised expectations, if they put in $600 million, they could expect to increase the cash flows from 50 to 80 million. Those are the 3 choices. You couldn't sell the theme park. Disney was not going to sell it to anybody else. So that choice was not even on the table. So let's see which of these choices makes the most sense. The first one is to continue operations and collect $50 million a year. Not a bad choice. The present value of $50 million a year, growing at the inflation rate, remember the theme park cost of capital is 6.62%, is $1.1 billion. So if they continue California Adventure with doing nothing, they get $1.1 billion. The second is to abandon the theme park, get the real estate value of $500 million. So clearly, if you compare the first two, you're going to continue over abandonment. That choice was easy. The third choice was the trickier one for Disney. They'd already made a bad bet. The question is, would they be willing to put $600 million more? If they put in $600 million more, the cash flows would increase by $30 million. Remember, it's only the incremental cash flows that you look at. That $30 million a year, growing at 2% a year with the 6.62% cost of capital, gives me a present value of $662 million. Remember to subtract out the $600 million from it. That's a net present value of $62 million. So of these three choices, investing more was the best choice. But Disney thought long and hard about whether they should spend more money because they'd been burnt once. You know since that which way they went, right? They not only invested $600 million, it became $1.5 billion, and now they're throwing in more money into the Avengers theme park. They've decided to go full bore into this. And I don't know whether they're doing it because the net present value, the incremental investment is a good one, or because they've sunk so much money now into the theme park that they can't step away. I don't have access to it, but it's a very dangerous place to be when you're throwing more and more money into an investment. It's not paying off, but you don't want to step back and say, this is the A-Rod contract, right? Basically, you've got a bad contract. You don't want to cut the contract. So I'm not sure whether California Adventures ever created that value that they expected, but the more money they spend, the more money they seem to be willing to spend. So when you look back at old investments, you're not just looking back with nostalgia. You're not expecting to see confirmation of your numbers. You're hoping to learn from those numbers to make better decisions. So it took us a while. Let's restate the investment decision. Let's see if now we have something we can hang our hat on. Invest in assets that earn a return greater than your minimum acceptable hurdle rate. The hurdle rate should reflect the risk in your investments. How do we measure risk? For a publicly traded company, we measure it as the risk you cannot diversify, a beta with equity, and a default spread with debt. And it should reflect the mix of debt and equity. Those are the weights on your debt and equity and your cost of capital. The return you make on projects should reflect cash flows, not earnings. Should reflect when the cash flows come in. The time weighting of the cash flows should have all side effects, synergies, opportunity costs should all be built into the cash flows. So I know it took us a while to get there, but this is the core principle. When businesses become great, they don't become great by optimizing financing mix, by finessing dividend policy. They become great by taking great projects. And that's why we spend so much time in the investment analysis. Any questions about anything to do with capital budgeting investment analysis? So I don't know how many of you got the second. I'm sure the bookstore doesn't have this. They're incredibly incompetent. I don't even know whether they'll have it by the end of the semester, to be quite honest. If you really, really, really are attached to a bound book, let me know and I'll get the printing store down the street to do it. It's going to be much quicker. I mean, they have the packet. They say it's going to be done. But the best thing for you to do, for the moment at least, is to print off enough pages to stay ahead of the game. So now we're going to talk about capital structure. Okay? And I'll tell you the biggest problem with talking about debt is we each bring in baggage when we talk about debt. I mean, think about it. Every religion on the face of the earth has some kind of adage about borrowing. And it's usually bad. Don't borrow money. Right? It's true across time, right? Whatever religion you look at, borrowing is supposed to be the source of all kinds of weaknesses. And God help you if you're a lender. There's a special place in hell already reserved for you in most religions. So when you talk about debt and equity, already you start out with this emotional no on debt. No, we're not supposed to borrow money. And it's amazing how many CFOs actually carry that into running businesses. I know it's difficult to step away from debt as a bad thing and think about it as a source of financing, but we're going to try, at least for a couple of sessions. So here are two questions we're going to try to examine over the next probably 5-6 sessions. The first is, for Disney, remember that the mix of debt and equity that we use to compute their cost of capital is 88.6% equity and 11.4% debt. And on each of your companies, since you've computed the cost of cap, I'm just acting like you have, okay, you have a mix that you have. For some of your companies, it's 100% equity, some it's 90% equity. We're going to look to see what the right mix of debt and equity is for your company. Not for all companies, because it's going to be different for different companies. So we're going to start with that trade-off. What determines the right mix of debt and equity for your business? And we're going to start off with very intuitive trade-offs, because ultimately we understand the intuitive trade-offs, the tools become easier to use. We're going to follow up by asking what's the right kind of financing for your company. And I kind of gave away the game, right? The right kind of financing for your company should reflect the kind of assets you have, where you're in the life cycle. We're going to go back and dress up those basics by giving. So for the next 5 sessions, nothing I say should be intuitively difficult, but the tools we're going to introduce will require some finessing, coming up with the right mix of debt and equity, finding the right kind of financing for your company. So let's start with a very basic question. Debt versus equity. I said there are 2 ways you can fund a business. Remember the financial balance sheet, debt versus equity. Let's draw the contrast. First, if you look at debt, debt gives you a fixed claim, a contract. Let me take out the word fixed, because it could be floating rate debt. It's a contractual claim. Even floating rate debt is a contractual claim. It is usually tax deductible. Much of the world, again, there are portions of the world like the Middle East where that's not true, but usually tax deductible. If you get into financial trouble, debt holders get first claim on the assets, and if you go bankrupt, they get first claim in liquidation. Usually debt comes with a finite maturity, and we'll see that why I said usually, because there might be exceptions to that rule. And finally, if you define debt purely, debt holders usually don't take a role in how a company is run. Again, there are exceptions to that rule, but that characterizes debt. Fixed claim, tax deductible, no role in management. Let's go to the other side. The nature of equity is that you get a residual claim. You get whatever's left over after everybody. That's why when we get to dividends, I'm going to argue that dividends are unnatural. Dividends are unnatural because if your claim is a residual claim, then why should you be paying a fixed dividend every year? So we're going to talk about the history of how dividend policy evolved, because I think it's very dysfunctional. Because equity by its very nature is a residual claim. You get whatever's left over after everybody else is paid. And when you think about what happens when you get into financial trouble, you're always the last person in line. In much of the world, and again there are exceptions, equity cash flows get no tax benefits. And finally, if you're a healthy firm, equity investors run the firm. So here's the trade-off. Equity gets a residual claim, you get to run the firm, lenders get a fixed claim, and they don't take a role in how the companies run. Now, when you think about debt and equity, you think about bonds and stocks. If you're a publicly traded company, you might say, hey, equity is shares and debt is bonds. But remember, every business is debt and equity. When you start a business, you know where your equity comes from? Every last dollar of savings you have is your equity. And then your first equity investors tend to be people who can't run away from you. Your parents, your siblings, your close friends who don't stay that close very long after you start asking them for money. But equity, when you start a business, comes in the form of owner's equity. As you expand, you go to venture capitalists, private equity investors, still equity. And as you go public, these can be public investors. Again, with debt, when you start a business, you don't issue bonds. You could try, but nobody's going to buy your bonds. You go to a bank and you beg for a loan. In fact, you might not even be big enough to qualify for a bank loan. It might be your American Express card. Now, how many small businesses owners max out on their American Express card? It's an extraordinarily expensive way to borrow money, but beggars can't be choosers. But it's usually bank loans, and then once bank loans go through, then it can be corporate debt. But essentially, you can see the hierarchy. So when we talk about debt and equity, I want you to remember that every business has debt and equity. Small businesses, large businesses, private or public. We're also going to talk about hybrid securities. We kind of mentioned them in the context of cost of capital. Hybrid securities are part debt, part equity. Classic example is convertible debt. Convertible debt, the debt portion is of course the bond. The conversion option is equity. Preferred stock, a hybrid security. Hybrid securities have some of the features of debt and some of the features of equity. So as we talk about debt and equity, keep that in mind, but a little bit of perspective here on how companies fund themselves. So these are publicly traded companies. This is a very old graph, but I think it captures how financing varies across the world. The predominant source of financing around the world is retained earnings. And retained earnings is equity. It's just equity money invested back. And then there's debt and new equity. So if you look across much of the world, you can very quickly see the outlier. The US has had a net equity that is negative, at least in this period. My guess is it's been true for the last 25 years. How does net equity become negative? Net equity is equity issuances, that's a new equity raise, minus stock buybacks. And the US, because stock buybacks have become such a big way of returning cash, net equity in the US has been negative. But in much of the world, if you look across financing, the predominant source of funding still remains retained earnings, and then there's debt, and then there's equity. I'm going to present you with what I call the financing hierarchy. This is how companies like to fund themselves, and you're going to say very quickly why companies have that hierarchy, but retained earnings is at the top of the list. A company given choices most likes to fund its projects, its new assets with retained earnings. So as we go through and look at the trade-off, keep that in mind. The mix of debt and equity used around the world is different. But the US has much more debt raised in the form of corporate bonds than bank loans. If I presented that graph to you 25 years ago, you go outside the US, it used to be all bank loans. In fact, what you're seeing across the globe is corporate bonds are becoming much more common. You go to Latin America, you go to Asia, you go to Europe. But 25 years ago, the US was the bastion for corporate bonds. Everybody else used bank debt. Yeah.
How much do you think the US tax policy and the cost of repatriating international retained earnings affects that fact that the US has negative
net equity? I think it is a little factor, but I think there's a much bigger issue, which is we're going to talk about corporate life cycles. As companies age, how the mix of debt and equity changes. And especially as you look at the portion of the US which tends to use net equity, you're going to see companies that are in the stage in the life cycle where it actually makes sense for them to reduce equity and increase their focus on debt. The tax policy has clearly played a role, which is I think for 30 years prior to 2018, the US had the biggest tax benefit to borrowing money. And that, not surprisingly, showed up as more debt being issued by companies. But we'll see how the tax benefit has evolved and how companies haven't quite adapted to the new tax policy. But everything will come into play as we look at these differences across countries. Okay? So with that set up, let's look at my 5 companies. So before we start asking what's the right mix of debt and equity for my publicly traded companies, let me show you what they have. So remember, 4 of the companies, Disney, Vale, Tata Motors, and Baidu. Before I get ambitious and figure out their optimal, let's see what they have as debt. First, if you look at the mix of debt, you can see that every company except Tata Motors has some leases, but the bulk of the debt is non-lease debt. That shouldn't be surprising. We're not looking at any retailers or restaurants, but if I'd thrown a Walmart in there, you shouldn't be surprised to see more of the debt show up in the form of lease debt. Second, if you look at the type of debt, Disney, 92% of its debt is in the form of bonds, 8% is bank loans. I'm going to ask you a kind of generic question. It's kind of an unfair question. Which is better? Would you prefer to borrow from a bank, or is it better to issue corporate bonds? You say corporate bonds. Tell me the advantage of issuing corporate bonds.
Because banks are very naggy. They can come.
They're very naggy. I don't know whether naggy is a good thing or a bad thing, but they'll ask you for more information. Is there an upside, though, to giving banks more information? You might be able to give them proprietary information about a project which allows them to lower the risk in the project. So it's not a clean, it is true, if you had to raise billions of dollars of debt, it's better to raise it, it's cheaper to raise it in the form of corporate bonds because there are less disclosure and monitoring requirements, less onerous on you. But even companies that borrow billions sometimes prefer to borrow with bank loans if they have proprietary information they can provide that the bank can use. You can't do that with a corporate bond because it'll be giving away information that you don't want the rest of the market to know. So it is true, but it's always true that it's better to have both options, right? If you can have both, you're going to have a lower cost of debt because you can play them off against each other. If the only way you can borrow is from a bank, you're subject to the tyranny of banks. If they all decide they're going to charge you 15%, 15% it is. So 92% of the debt in Disney is... So it'll be interesting to see the 8% that's bank loans, to see which assets they funded with bank loans. My guess is it's mostly their physical real estate assets where banks might have a better rate for you because they can observe, they can monitor, but 92% of the debt is. But even if you look across the rest of the world, you can see how corporate bonds are starting to show up in the rest of the world. Look at Vale, 40% of the debt now takes the form of corporate bonds. This isn't 1990 anymore. Brazilian company, 40% of its debt is corporate bonds. And even Tata Motors, 38% of their debt is corporate bonds. Baidu has 100% of its debt in bank debt. My guess it's, it's bank debt in, when you look at the currency, you're going to see where it's coming from. But most of it is not even coming from China. If you look at the maturity of the debt, much of Disney's debt, 49%, is 1 to 5 year debt. As we describe the debt, I want you to think about, and remember we said debt has to match up to your assets. I want you to think about, does the type of debt Disney have reflect the kind of assets they have? So a lot of it is 1 to 5 year, but they have a 13% of their debt with very long term maturities, more than 20 years. If you look at Vale, it has the most long term debt on average of any of the companies. 29% of the debt is 5 to 10 years, 38% of the debt is more than 20 years. Tata Motors seems to have found a sweet spot, or maybe the banks will only lend 5 to 10 years. Remember, both factors play in. 57% of the debt is 5 to 10 year debt. And Baidu has a lot of short-term debt. Again, as for the moment, just leave that as a descriptive and start thinking about that debt match up to what you'd expect to see in these companies. If you look at Disney's currencies, 94.5% of their debt is in US dollars, 5.5% in foreign currency. This is a very unfair question, but let's see whether you remember random numbers from 7 sessions ago. You remember what percentage of Disney's operations were foreign? We did this when we computed the weighted average equity risk premium for Disney. Was it 2 digits or 1 digit? Let me make it. No. It was 18% of their operations were non-US operations. I know this is not final because we haven't looked at the numbers deep enough, but only 5.5% of their debt is US dollar debt, foreign currency debt. Your mind should say, hey, how come more of the debt is not foreign currency? We'll come back and re-examine it. Okay? 66% of Vale's debt is foreign currency debt, which means it's US dollars primarily. Does that make sense? It's a Brazilian company, but it's a mining company. If you look at how, what currency mines get their cash flows, and it's usually US dollars. You're selling into dollar market. 71% of Tata Motors is rupee debt, 29% is foreign currency debt. If I'd shown you that in 2007, that would have been surprising. You said, what the heck is Tata Motors doing borrowing in a foreign currency? But in 2013, it makes sense. Why? The Jaguar Land Rover debt is foreign currency debt. And here comes the debt that when I computed, I looked and said, really? Did I screw up? Baidu's debt, 18% is in the local currency. 82% is foreign currency debt. See why I was surprised? Where does Baidu get all of its revenues? Huh? It's all in China. As I said, I haven't ever talked to a person outside China who even knows what Baidu is. It is a completely Chinese company, but 82% of its debt is foreign currency debt. I have no way of explaining it. We'll come back to it. This is actually a common problem around many emerging markets now, is emerging market companies that choose to borrow in US dollars and euros for the worst of all possible reasons, which is it looks cheaper. Of course it's going to look cheaper. You go from a 7% inflation currency to 2% inflation currency, of course it's going to look cheaper. And you're going to see entire countries go insane, mismatching debt. Turkey is a classic example. Okay? And finally, I also looked at what percent of the debt is fixed and floating rate debt. Is everybody familiar with how fixed rate debt, you set the interest rate up front, it's set for the entire period. Floating rate debt, the interest rate varies from year to year, but not randomly. It's pegged to something. It used to be pegged to LIBOR before LIBOR became contaminated. But it could be pegged to the T. You can peg it to any market interest rate, prime rate, T-bond rate, T-bill rate. So essentially a floating rate debt, basically you pay 2% over the T-bond rate no matter what that rate is. In fact, that floating rate concept found its way into mortgages in good and bad ways, right? Adjustable rate mortgages became very hard about 15 years ago. where you did not have a mortgage rate set up front. It actually varied from period to period, fixed and floating rate debt. For the moment, I'm just going to leave it as this because I'm going to come back and revisit the page. And the question I'm going to ask is, does each of these companies have the type of debt I would expect them to have, given what I know about these companies? So let me give you my simplest way of answering the question, should I borrow money? Tell me where you are in the life cycle, and I can pretty much tell how much debt and equity you should be using. So let's start easy. If you have a startup or young company, it should be funded almost entirely with equity. Why? Because you really can't afford to borrow money. And there's another reason. All of your value lies in the future, right? It's in growth assets. Why would you want to risk that by going out and borrowing money? So if you're a young company with debt on your books, you better explain that came out of desperation because you could not raise any other capital. And the minute you can raise equity, what's the first thing you need to do? If Pinterest has any debt on its balance sheet, it needs to pay off the debt. So if you're a young company, I would expect you to be equity funded. The problem is, if you're a young company, the only way you might be able to raise equity is your own savings and your family's savings, and that means you're going to stay small unless, so you can see the tension that it's going to create. Is that I want to grow faster, I need to borrow money, I'm going to try to restrain you because I think that you might be better off growing slower and not using that debt and putting your entire business at risk. As you become a young growth company, your access to equity changes. Instead of being entirely owner's equity, you now have venture capital. And increasingly, you got private equity, and even public equity is coming in. We'll talk about the gray area that's been created between the VC market and the public market, where investors like Fidelity are willing to invest in private companies for extended periods. Think of Uber. And then you become a high growth company and you go public and you got common stock and warrants. Your choices start to expand. That's one of the advantages that a public company has over a private company. It's not that equity is cheaper per se, but that your choices expand. And as your choices expand, your cost of equity will reflect it. But you're still predominantly funded with equity. And then you start to become a mature company. Your capacity to borrow money increases. Why? Because you have lots of cash flows coming in from existing projects. You don't have very many investments. And if you have a tax advantage of borrowing, you're going to swivel towards that. And as you go into basically decline, you're going to have to retire the debt because you don't want the debt hanging over you while you become a smaller firm. But you'll also be retiring equity. So you're just becoming a smaller firm with less debt and less equity. So here's my suggestion to you. For the next few weeks, look at the Wall Street Journal for announcements by companies that they're going to raise financing. Then given the name of the company, ask yourself, does that make sense? You'll be surprised at how often look at the news story and say, that doesn't make any sense. 3 years ago when Tesla announced they were going to raise $5.5 billion in debt, my reaction was, you must be kidding me. Why? You have a money-losing company with, let's give it the benefit of huge growth potential, a great car. Why would you put it at risk by going out and borrowing $5.5 billion? And don't tell me that you are desperate. You are a company that the market loves, or the market price is high. You had the option of raising equity. Why would you ever? I never understood it. In fact, I spent 3 pages on a blog post trying to come up with any conceivable excuse. And finally I said, I can't come up with anything. You guys try. The only thing I can think of is maybe Elon tweeted out, we're borrowing $5.5 billion, funding secured, and the next thing you know, they had to actually go out and borrow $5.5 billion to borrow. Because if you think about Tesla's troubles now, one of the reasons that people are worried about them is debt payments are coming due. From what? From the $5.5 billion you borrowed when you didn't have to borrow the money. You now have a bond ratings agency that chases you up and down the ratings every time something happens to you. This was a self-inflicted wound. So very simply, just look at where a company is in the life cycle and start thinking about what should a company do. So GE starts to sell off businesses. That cash is going to go somewhere. It can't go all to equity because that's a very dangerous thing to do. You're going to end up with this hugely levered company. So start thinking about what would I expect a company to do given where it is in the life cycle, and then look at what the company actually does. So what you have in this life cycle are transitional phases. So a young private company, your first transition is you get too big for owners' equity, you got to approach the VC. And remember, VCs are not charitable institutions. They're going to extract their pound of flesh when they invest in you. This is like Shark Tank with really, really, really crazy sharks. So you try to sell a business, you think that the VC is entitled to only 10%. He says, no, I think I'll take 90%. And you compromise and settle for 85%. Why? Because if you're desperate for capital, that's basically what happens is VCs will demand a disproportionately large share. It's not because they're bad people. That's their job. And your job is to find other options. Say, no, I'm not giving up 55%. So that's the first transition from owner's equity to VC. And it's a big one because for the first time, you now are accountable to another equity investor. That VC phase eventually becomes a public equity phase, the Pinterest, the Lyfts of the world. And what usually used to drive them there was the need for more capital than the VCs would provide and the need for VCs to exit. Remember, VCs don't want to be owners of your company for the rest of eternity. In fact, every VC pricing, notice again, and use the word valuation, has an exit. Basically, they said 3 years from now we're going to exit because you need to collect your cash and move on. So the transition to going public is partially driven by the need for VCs to be able to monetize their success. Remember, the day that Benchmark Capital will collect, Benchmark Capital invests in Uber when it was a $1 billion company. And the estimate is right now, Uber, given how Lyft was priced, will be priced about $125 billion. Are they going to make a ton of money? Yes. But until Uber goes public, they're not going to be able to cash out. In fact, even after Uber goes public, they have to wait 6 months to a year. Most IPOs, those VCs have to wait because that's part of the clause that gets built in. And then 6 months or a year later, they can cash out. So there's that private company to public. And this is where things have gotten a little messy. Until about 25 years ago, once you got to be about $1 billion or $2 billion, you had to go public. There wasn't any intermediate place for you to go. But as Facebook initially showed, and then companies since have done, Uber is the classic example, you can stay private and raise immense amounts of equity. Uber has raised about $30 billion of equity as a private company. No company 20 years ago would have been able to do it. But the reason they were able to raise $30 billion is not only did they have VCs, but they had companies, investors like Fidelity and the Saudi investment fund. I don't even know what they were doing playing in this particular game. Essentially, there are ways of raising capital now, and that effectively has meant private companies can stay private for longer. You're saying, why would they want to? Because the minute you become public, your disclosure requirements increase, the monitoring increases, the corporate governance issues increase, so companies are putting that off. So the third transition is to public. And then there might be a reverse transition, which is if you get to be an old, mature company, you might decide to go back private again. Why? Because you got to fix issues and problems that you don't want to do in the public eye. And you might be easier, those might be easier. And these are the LBOs and the going private transactions, the KKRs and the Blackstones do. So you go from owner-funded to VC, VC to public, and eventually you might go back to private, and then the game might be over. So that's why the life cycle fits so well. So let's look at the financing mix for a company. I want to kind of establish some measures up front. So when I say something, you know exactly what I'm talking about. From this point on, when I talk about debt ratios, I'm talking about debt over capital, debt as a percent of debt plus equity. Remember, you can also use a debt to equity. Of course, if I give you one, you can get the other. Second, when I talk about debt ratios, I'm going to talk about market debt ratios. Frankly, I couldn't care less about your book debt ratio because it doesn't matter much to me. It's market debt ratios. When I talk about debt, it's all interest-bearing debt and lease commitments. So when I talk about the optimal debt ratio for Disney being 40%, that 40% includes leases and interest-bearing debt, and it's a percentage of the market value of the firm. The reason I bring that all out is some of you, when you were doing the Whole Foods case, made the mistake of going onto Bloomberg and checking the debt ratio for Amazon. And you found a number that did not match up, didn't even come close, because I think Amazon's actual debt ratio was like 6% debt, 94% equity. If you go to Bloomberg, it said the debt to equity ratio for Amazon is 54%. And you freaked out. What did I miss? You miss nothing. Basically, when you see services, most services, when they report debt ratios, report book debt ratios. You can't control that. That's why the best thing to do is never trust a ratio report by a service, not because they don't know what they're doing, but you don't know what goes into debt and what they're scaling it to. So I want to be clear, from this point I'm going to talk about debt ratios. We're talking about market debt ratios. We're talking about all interest-bearing debt and lease commitments. And I'm not going to start, it's not something I'm going to start just because the accountants have finally come to their senses. This is the way I've always thought about debt. So let's look at the trade-off. Okay? So essentially, what I'm going to do for the rest of today is talk about debt versus equity. What are the pluses? What are the minuses? Why would you choose one over the other? And if there is a trade-off, is that trade-off going to lead us to the right mix of debt and equity? So let's start with the illusory benefits of debt first. And these are the benefits that some companies claim is the reason they borrow money. You shouldn't borrow money just because debt is cheaper than equity. That's just like saying lira debt is more expensive than dollar debt. Now, debt is always going to be cheaper than equity, even if you don't have a tax benefit. Why? Who's the first in claim to get the cash flows? The lender. Who's last in the line? You. If the guy in front of you is charging 7%, you're going to charge 9%. So the cost of debt is always cheaper than the cost of equity. Okay? So by borrowing money at a lower rate, won't you lower your cost of capital? If it were that easy, then debt, more debt I take, the lower the cost of capital. Why doesn't that logic work? Because let's get rid of that illusion first. What happens as you borrow money? It's true, you're replacing more expensive equity with cheaper debt, but what else is true? Both equity and debt become riskier. Think of why. You're the equity investor. You're now an equity investor in a more levered firm. Your earnings are going to be more volatile. You're going to demand a higher cost of equity. If you use betas, your levered beta gets higher, your cost of equity gets higher. The cost of debt is even simpler. Why is your cost of debt going to go up as you borrow more money? You go to the bank and you save $100 in debt. You're going to get a very different interest rate than if you save $100 billion in debt. Because the bank borrows more. So the more you borrow, the higher interest. So basically what you have here is a trade-off. Debt is always cheaper than equity, but borrowing money will push up both the cost of equity and debt. And what we're looking for is that mix of debt and equity with a trade-off works in your favor. So I'm going to list out 2 big benefits of debt and 3 potentially large costs. And I'm going to do it purely in intuitive terms. So the next 45 minutes, I'm not going to mention a single number, but I want you to get the intuition first before we delve into the tools. There are 2 big benefits of debt. The biggest benefit of debt is a tax benefit. If you really want companies to not borrow money, I have a very simple way to do it. Change the tax code. Either change the tax code to take away the tax benefit of debt or give equity an equivalent tax benefit. It's a tax benefit of debt. The second is a little more subtle. There are some companies where borrowing money can make the company a better run company. It's called there's an argument that debt can make some companies more disciplined. Sounds weird, but we'll come back and deal with it. But it's a subset of companies. Borrowing money is going to make the company a better run company. Tax benefit and added discipline. It's got to be weighed off against 3 costs. The first is an expected bankruptcy cost. Every time you borrow money, you increase your likelihood of bankruptcy. Saying, what if I'm Apple? Even for Apple, borrowing an extra $100 billion will increase the probability from 0.01 to 0.03%. It will always go up. So the expected cost of bankruptcy, and that cost of bankruptcy will get higher as you borrow more money. Second, there's an agency cost. Fancy way of saying that when you borrow money, you've got a new player in the game with a very different set of incentives than the existing players. The existing players are equity investors. What do they want? They want upside, they want growth. You invite lenders into the game, they come in with a very different set of incentives. What do lenders want? They want to get paid. That's first and foremost, top on the list. Given a choice between being paid interest and going for higher growth, if lenders land companies, they would run it very differently. And this plays out as cost for equity. It sounds very unfair, but because lenders have a different set of objectives, equity investors will end up bearing the cost. We're going to talk about agency costs. And finally, every time you borrow money, you give up some future flexibility. It's nice to have that excess debt capacity for a tough day, when you have a downturn, when you have a great project. And if you use up that debt capacity, you lose some future flexibility. So I'm going to take each of these costs and benefits and play them out. Let's start with the easy one first. The tax benefit of debt. Here's how it plays out. When you borrow money of interest expenses that are tax deductible, when you raise equity and you have cash flows, they come out of after-tax cash flows in much of the world. So let's start with a very basic proposition. If the tax benefit of debt comes from the fact that interest is tax deductible, the higher your marginal tax rate, notice I didn't use effective tax rate, the marginal tax rate, the greater the tax benefit of debt. Why am I using the marginal tax rate? Because interest saves you taxes the margin. So if your marginal tax rate is 40%, you will borrow a lot more money than if your marginal tax rate is 21%. And I picked those numbers deliberately because roughly speaking, 40% was the marginal tax rate in the US in 2017 and 21 to 25% was the marginal tax rate in 2018. Big change. So holding all else constant, you should expect companies in the US to be borrowing a lot less money now than they did in 2017. So one of the first things I looked at in 2019 when I was looking at the data is it happening? Are you seeing debt in the US go down because of the tax benefits becoming smaller? So far, the answer is no, which can reflect either the inertia in this process or the fact that companies have completely lost sight of why they borrowed money in the first place. And if you look across countries, you can see then which countries should have the most debt. I would expect German companies to carry a lot more debt than Irish companies. Why? Because the marginal tax rate in Ireland is much lower than the marginal tax rate in Germany. I would expect Ryanair to be the least levered airline in the world, which it happens to be. One reason is the tax benefit for debt is so much lower in Ireland than in the rest of the world. So tax benefit of debt is a function of your marginal tax rate. The higher your marginal tax rate, the greater the tax benefit of debt. So let's try this out. And with each of these, I'm going to give you a what-if analysis. Let's see if we can work it out. When you look at real estate in the US, there are two ways in which publicly traded real estate in the US is structured. One is in the form of real estate corporations, which are like any other company. They pay taxes, the corporate tax rate. The other is real estate investment trusts. And real estate investment trusts are a very, very unique setup. They were created by an act of Congress in the 1970s. Real estate investment trusts are allowed to invest only in real estate, so you can't go out and do other stuff on the side. You're exempt from corporate taxes. Don't get too excited because that exemption comes with a catch. You're exempt from corporate taxes, so your income flows through. You have to pay 95% of your income as dividends. Do you see why Congress was okay with exempting you from taxes? They said, we'll get you one way or the other. Because when you pay the dividend, it will become taxed to somebody who will tax you. My 95% of your income gets paid out as dividends, but they're tax exempt. So I'm going to ask you a question that at first sight the answer seems obvious, but then I want you to dig a little deeper. Based purely on what we just talked about, that the tax benefit of debt is based on the marginal tax rate, who should have more debt, the real estate companies, the real estate investment trusts? Looks like real estate corporations should, right? Because they get the corporate tax and real estate investment trusts don't. But that's a little shallow, and here's why. That income gets paid out as dividends to stockholders who might have a 44% tax. So in effect, there is a tax benefit even at real estate investment trust depending on who owns stock in the company. If it's tax-exempt pension funds, then you're right, real estate corporations will end up with more debt, but it's wealthy individuals who collect that dividend and then pay a high tax. Effectively, they're getting that tax benefit through the dividends and the earnings of the company flowing through. But here's another scenario where this will play out. I know a couple of people in this class are doing cruise lines. So anybody doing a cruise line? Carnival Cruise Lines, Royal, no, Caribbean. Yeah. No, nobody wants to admit to it because they're afraid of the question. If you're doing a cruise line, no, you don't have to admit to it. Take a look at your effective tax rate for the company. It's like 1%, 2%. You know why cruise lines have really low tax rates? An astonishingly large number of them happen to be headquartered in Liberia. Liberians are not big cruise takers. Panama or Liberia, there you go over there. For a simple reason, the tax rate is 0. And they actually claim that they make most, remember the way you're taxed around the world is you're taxed based on where you sell stuff. So if you're a Liberian company selling stuff in the US, you still pay the US corporate tax rate. You know how cruise lines get around this? How many of you have been on a cruise? I've been on one. I will never go back on another one. It's a very surreal experience. They feed you, I think, non-stop. And if you're an alcoholic, you fall off the ship because they. But one of the interesting things is for the first 35 or 40 minutes after you leave the port, nothing happens. Then all of a sudden people show up with wine glasses and things that you can buy. You know why? Because once you get past 10 miles from the shore, you can claim that your revenues are in the high seas and therefore you can't tax me. You think that's very clever. This is actually an interesting ploy. Does Goldman Sachs actually have to be in New York? Why not put them on a few ships and send your traders out? This is something to think about, right? You can trade on the high seas, but online retailers do their own version of this, right? Because when you buy stuff online, there is no physical space where it happens. You can claim that iTunes Ireland sold you that whatever song you bought. So it's an interesting gap in taxes because taxes are so based on the physical location of a transaction. But holding all else constant, because cruise lines pay so little in taxes, I would expect cruise lines to have very little debt. But cruise lines actually carry a lot of debt, but they carry it in cycles. Every time you have to buy one of those huge monster ships, they borrow the money, then they very quickly try to pay it off. Then they borrow the money again. It's almost like they can't make up their mind. But if you look purely from a tax benefit standpoint, I would expect cruise lines to borrow less money than most other companies. So any questions on the tax benefit of debt? Incidentally, can somebody else complete what happened with the tax code last year? In addition to the marginal tax rate coming down, which reduces debt, what else did the marginal tax code do to the interest tax reduction? Nobody remembers? Nobody? Yeah. In fact, there's a phased out cap. Your interest expenses cannot exceed 30% of your EBITDA. Which means if you're a company which borrows a lot of money and your interest expenses go above 30%, your tax benefit is gone. It's a pain in the neck from a calculation standpoint because when you do your cost of capital, you know what you have to do now, right? Take the interest expense. If it's less than 30%, you'll give them the 25% tax benefit. But if it exceeds 30%, that portion will actually, we'll talk about ways of bringing it in, but the tax code clearly was pushed towards reducing the dependence on debt in companies. And if it works, you're going to see debt ratios at U.S. companies start to come down over time. It will take a while because inertia takes a long time to get out of. But the tax code clearly inflicted some pain on the tax benefit from interest expenses. Now let's take the second argument for debt. I call this the Volvo argument for debt, and let me explain why. Let's assume it's 10 years out. Okay? You joined an investment bank, a consulting firm, you've risen up the ranks, you become managing director, partner, whatever your end game is. You moved into the suburbs, you have this huge house with 2 dogs, 2 cars, 2 spouses, whatever makes you happy, And every day you take the train into work, and you have 2 cars. Your first car is a Volvo 960 extra armored. You like driving a tank around town, like side airbag, front airbag, all kinds of protection. Your second car is a tin trap. I don't want to insult any of you, so I'm going to pick a car that probably none of you own. So Yugo, or a Trabant. Trabants are these East German cars that shook as you drove them. Pieces would fly off the car, So you take the train into work. Your first day is your lucky day. You drive your Volvo into the train station at 6 o'clock in the morning. You park your car, you get on the train, you go into work, you work all day, you work all evening, you work all night. How do you think you afford the 2 cars, the 2 dogs, the 2 spouses? Now, 10 o'clock at night, you get off the train, you crawl to your car, you're exhausted. You just want to get home. You get in your car, you get ready to drive home. You live only 5 minutes away from the train station. But between the train station and your house, there's a traffic light, which when it turns red, takes forever to turn back green. So you pull to the top of the hill, the light turns red. You say, oh, drat. I'm censoring as I'm going along because the words you'd use would probably be stronger. And as you sit there watching the red light, illegal thoughts start to cross your mind. So what if I ran the red light? There are 2 things you normally worry about when you run a red light. One is getting a ticket, but these are the suburbs. At 10 o'clock, the police have all gone home. You're not going to get a ticket. The second thing you worry about is getting hit. Initially, that stops you, but then you remember you're in your Volvo extra armored. Somebody hits you, you get a little dent on the side. The other guy's all crumpled up. So what do I care? You run the red light. You make it home safe. And the next day you repeat this process in your little Yugo. You get in your car, you chug to the train station. You park, you go into work, you work all day, work all evening, work all night. 10 o'clock you get back in the Yugo, you drive to the top of the hill, the light turns red again. It's like a conspiracy. You get ready to hit your gas, go through it, just like yesterday. Then you remember, I'm not in my Yugo. I'm now in my Yugo. If I run this red light and a bicyclist comes along and hits me, I could roll off the road. I'm going to stop. You see, what's this got to do with debt and equity? Think of the Volvo as an all-equity funded company. Think of the airbags as cash cushions. Think of the red light as a bad project. Where do you take the bad project? I protected you so much from your mistakes. You said, who cares if I lose 50 million? I'm going to take the bad project. I've cushioned you from your mistakes. Think of the Yugo as the same company stripped of its airbags. And think of why you stopped. You're afraid of getting hurt. Here's the discipline argument for debt. If you're the manager in an all-equity funded firm with a lot of cash flows coming in, you're going to get sloppy and lazy. Why? If you take a bad project, who's going to notice? See, here's what I do. I make you borrow a ton of money because then you have to make interest payments, right? And if you take a bad project, what could happen? You might not be able to make the interest payments and you could go bankrupt. You don't care about the bankruptcy per se, but if you go bankrupt, what happens? You lose your job. I'm trying to make this personal. It's an extreme argument for debt, but it's an argument that was made. It's called the Jensen free cash flow argument for debt. Remember Jensen? He likes to attach his name to pretty much everything he does. There was a Jensen's alpha we talked about, right? Jensen free cash flow argument for debt was made in the 1980s as an explanation for why you saw leveraged buyouts of old mature companies. The only problem, and the reason I never quite bought the Jensen free cash flow argument for debt, was it went overboard. It wasn't just 40% debt, it was not. It's like taking even a Yugo into the car dealer. And even Yugos come with little air balloons. They're not quite airbags, they're tiny. And replacing them with air knives. You know what those are? They're knives that come right out of the steering. You hit something. Are you ever going to drive that car? You think, I don't know, 5 miles I can walk, 15 I can run? Somewhere between the Volvo and the air knife, there's a happy compromise. And that's what we're looking for with that, is maybe you can borrow just enough money to make you think about the consequences. I said it's an extreme argument for debt. So I'm going to present you with 3 groups of firms, and I'd like you to tell me which of these 3 groups of firms you think is the best candidate for debt, given what we just talked about. Forget about everything else. Given this discipline argument, which of these 3 groups is the best candidate for borrowing money? They're all conservatively financed, which means they're all pretty much equity funded. The first company is a privately owned company. The second company is a publicly traded company with millions of investors, none of whom own a big stake in the company. The third company is a publicly traded company with lots of investors, but a couple of them happen to be big activist investors. Which one of these 3 companies will benefit the most from borrowing money, purely from the perspective of discipline? Well, let's start with A. If you're a privately owned company and you need debt to discipline you, you got a serious problem. It's your money. If you're that self-destructive, nothing is going to save you. So if you're a privately owned business, don't talk to me about discipline argument. It doesn't make any sense. But between B and C, you see why B is a better candidate for debt? In C, there is a disciplining mechanism called Carl Icahn. He's looking over your shoulder saying, what the hell are you doing? Why are you taking that project? If you're a publicly traded company, an AT&T, where the heck is the discipline going to come from if it doesn't come from the fact? I mean, AT&T, again, has gone way overboard with that. But you can see why companies like AT&T will fund with debt, because it forces these managers to think through the consequences. Tax benefits and added discipline. That's it. There are no other good reasons for debt. There are a lot of illusory reasons. It looks cheaper. It prevents delusion. None of those really work. These are the only 2 good reasons for debt, fundamental reasons for borrowing money. Let's look at the other side of the spectrum. The first and biggest cost when you borrow money is an expected bankruptcy cost. And there are 2 elements that go into an expected bankruptcy cost. The first is the probability of bankruptcy, which will always go up for every company as it borrows more money. That's a given. It'll go up more for some companies than others. Based on what? The more volatile your income is, the riskier the business you're in, the faster your probability of default. That's why an Apple will probably be a lot more reluctant to borrow than the Coca-Cola was 25 years ago. Even though Apple has more money, it's in a business where tomorrow you could wake up with the smartphone business imploding. So it's going to depend on the level of income and how volatile it is. It's the probability of bankruptcy. That's the easy half. The second half is the cost of bankruptcy. What's the cost of bankruptcy? Human beings. Sounds ridiculous. What's the cost of bankruptcy? Your stock price goes to zero. That happened way before you went bankrupt. The stock price has been sliding down, right? There are two costs to bankruptcy. The first is what I call a dead weight or a direct cost. This is what happens after you declare bankruptcy. In the US, when you declare bankruptcy, you enter the legal system. Incredibly efficient system, right? Take cares about time. I still remember in the 1990s when I became a US citizen. Show you how naive I was. But 6 months after I became a citizen, I got a letter in the mail informing me that one of my citizenship duties had come due. I was invited, if you can use the word, to jury duty. To show you how naive I was excited about jury duty. I circled the date on my calendar and told my wife, you have to remind me, this is great. And I show up on the day expecting balloons and cakes. And there's this bored-looking woman sitting behind the table. So what are you here for? Jury duty. So go sit in that chair. What do I do? What's the terminal? What am I looking for? This number. So what number? She points to a 6-digit number. I said, what happens if the number comes up? She said, you go into that courtroom. So what if the number doesn't come up? Come back tomorrow. I said, I can't keep coming back every day. I have a job to do. She said, we'll pay you $12 a day. So okay, that does it. I'll come back for the rest of... That kind of gives you a little window into how the legal system thinks about your time and my time, which is worth about $12 a day. This is the system you're going to end up with when you go bankrupt. Time comes to a complete standstill in the legal system. There was a study in the 1970s that looked at railroads in the US that went bankrupt, which was pretty much every railroad. And it looked at how long it took between the time a railroad declared bankruptcy until a creditor actually saw $1 in payment from the railroad. You know how long it took? 7 years. Very biblical. And half the assets of the railroad ended up as... Who's the only person who gets paid? Well, your time and my time... There's one person in that room, actually 2 people in that room whose time is always valued. The legal costs sucked up 40 to 50% of the proceeds. My son works at Duff & Phelps, who's an appraisal firm. So about a year ago, I asked him, or maybe a year and a half ago, I asked him, what project are you working on? He said, the Lehman Project. I said, the what project? He said, the Lehman Project. I said, what Lehman Project? He said, the Lehman bankruptcy. I said, that was in 2008? I said, we're still working on it, charging an hourly rate. You know the collective legal fees on the Lehman bankruptcy hit $2 billion 10 years into the process. This is not a process you want to get sucked into because it'll suck all the good stuff. It's like a dementor process, right? All the good stuff gets sucked out. Right? That's a direct cost of bankruptcy. And if you end up there, you're not going to get your liquidation value back. If that's your dream, it's not happening. 30% of the liquidation value is going to go somewhere else. Because you've got to wait and lawyers are going to collect their fees. But if that were the only cost, companies would probably borrow more money. Because the second cost is really terrible. It's what I call the indirect cost of bankruptcy. What is the indirect cost of bankruptcy? If people think you're in trouble, are you in trouble? Let's start with the people. Let's say your suppliers think you're in trouble. What happens? They want to be paid in cash. Forget about it, accounts receivable. Your customers think you're in trouble. What might happen? They might decide not to buy your product because they might need servicing. Your employees think you're in trouble. They're checking out other job offerings while they're sitting there. I don't know whether I'll have a job a month from now. The perception of being in trouble puts you into a spiral of trouble, and that's called an indirect bankruptcy cost. Your expected bankruptcy cost is a product of the probability of bankruptcy, which is a function of how uncertain you're about income and that cost of bankruptcy. So let's see why that cost of bankruptcy might vary across companies. Let's suppose I came to you with 3 companies and focus again just on the bankruptcy cost and perhaps just on the indirect bankruptcy cost because the rest of the process will play out. So you've got a grocery store, an airplane manufacturer, or a high technology company. You can name the high-tech company, a software company, a services company. Based just on expected bankruptcy costs, which one would you expect to borrow the least? Assume they all had the same operating income. So last year they all made $1 billion in operating income. So they look profitable. But I'm going to argue that one of these 3 companies is going to borrow a lot more than the others. Which one? You think the airline should borrow? Let's say you're an airline, you borrow money, and you get into trouble. You become a BBB rated airline. What's a typical aircraft? When you look at a Boeing contract within Garuda Air, for instance, it was like a 15-year contract, right? No airline wants to enter into a 15-year agreement with somebody who might not be around. Forget about getting spare parts for your plane and servicing, etc. So if you were to look at just aircraft manufacturers, whereas in a grocery store, I don't know about you, but I don't walk in and say, is this a AAA rated grocery store? Or frankly, I don't care. It's not like I plan to bring the lettuce back in 5 years. If they're around tomorrow, I'm okay. A grocery store can afford to see its ratings collapse and its operations not implode, but an airline can't do that. So if I were advising Boeing, and this might be the wrong time to give them advice, in their healthy days, before they had problems, I said hold back on the debt. So when we talk about optimal debt ratios, I know a couple of people in this class who are probably doing Boeing. They're going to come up with an optimal debt ratio, but the advice you might offer them is stay below it because it's better to undershoot than overshoot because if you make a mistake, it could be disastrous. A technology company can look profitable, but as I said, if you're uncertain about those profits, you're going to hold back. The probability of bankruptcy is much greater for any given level of income if you have uncertain income. So you can already see, even with this very intuitive trade-off, that some of your companies should borrow more than others based on just describing the company. Which brings me to my agency costs. Agency cost is a fancy term in economics, but it's actually very simple. You know what an agency cost is? When you ask somebody else to do something for you, notice they never do it right. They never do it the way you'd have done it. You're in a group, you're in a late at night, you're working on your project, which you will be on May 12th. Okay? Because your project is due May 13th, in case you're wondering what's so special about May 12th. One of the people offers to go out to get sandwiches, not because he's being helpful, but he just doesn't want to work on the project. He says, I'll just go get the sandwiches. So each of you gives the order, and you're very specific. You say, I make sure I get turkey on wheat, no mayo, lots of mustard. What does he come back with? Ham on white, lots of mayo, no mustard, because who cares, she's allergic, I don't care, she'll have a little, she probably has an EpiPen, it's not my sandwich anyway. That's an agency cost. The classic version of agency cost is, anybody here have kids? Okay. I'm going to describe classic agency costs. Hiring a babysitter. You know how this works in the suburbs? When we used to have young kids, first you'd have to have a 6-week lead time to get the babysitter lined up with a backup babysitter. On the day, we used to go out twice a year, and very quickly you're going to see why you end up with twice a year as being your target for the year. So 7 o'clock arrives, the babysitter's not there. 25 minutes later, she saunters in, doesn't even notice time. She operates on a different time zone, I guess. And as you leave, you give her parting instructions. The kids all go to bed at 9 o'clock. And no sugar, no ice cream after 8, and you leave. Go for dinner. The babysitter, puts herself comfortably on the couch, starts watching, I don't know, some show of hers, the Kardashians. And then, and kids sense weakness. They are incredible. So they know when she's deeply immersed in the show, they come to say, we want some ice cream and candy. The first reaction of the babysitter is, your parents said no. The kids know this is the weakest moment. They raise the ante. So we want candy and ice cream. We want candy and ice cream. And the babysitter says, okay, I can listen to what the parents said and not give them the candy and ice cream, but then I won't get to watch the rest of my show. You know what? Take the entire bowl of candy and ice cream. Go upstairs. Leave me alone. So the kids go upstairs with the candy and the ice cream. All of the candy, all of the ice cream in the house. the babysitter finished watching. So you come back home at 9:30. You notice the babysitter is in a hurry to leave. You don't know why. She collects her cash, she's out of there. And then you hear the sound of things hitting the walls upstairs. You know what the heck is this? Your kids are bouncing off the walls on a sugar high. They don't go to sleep. You lose a night of sleep. This is why you go out only twice a year. This is a classic agency problem. And there are two ways you can deal with an agency problem. One is the monitoring solution. You know what that is? You install cameras all over the house. And while you're out at dinner, you watch intently. So one eye's on your food, one eye's on the cat. Oh my God, she's feeding them ice cream. We have to get back right now. Maybe have zap guns set up around the house. You can shoot things at the kids or shoot things at the babysitter. That's a monitoring solution. The other is to assume that if you go out, you're going to spend a night without sleep. You build those costs into your decision and you go out less. You see how this plays out with debt and equity? You guys be equity investors, you guys be lenders, right? We're going to go borrow money from the bank. So when we go to borrow money, we describe the project we're going to take as really safe. We look after your money like it's our own. Remember we talked about trusting bankers? It's an oxymoron because you don't stay trusting in a banker for very long. You lend the money to the equity investors without any strings attached. You know exactly what's going to happen now, right? I now have the money, no strings attached. I'm going to take far riskier projects than the projects I described. I'm going to pay myself dividends buyback. I'm going to go crazy. This is why you're not a trusting banker. So what do? When you lend money to me, you write covenants. Basically, so you can't do this, don't even think about it. And then you hire monitors, lawyers to watch over. Guess who pays for the lawyers? It's not the bank, it'll be you through. Or you say, look, these guys are going to screw me over anyway, no matter what they tell. I'm going to just charge you a high interest rate. You just build it into your cost. When you have agency costs, it either shows up as much higher interest rates up front because the banker says, I don't know what you're going to do with my money, or it shows up as monitoring costs that you pay as the borrower. And every time you borrow money, you find, I describe borrowing money as putting yourself in a straitjacket. And the more you borrow, the tighter the straitjacket gets because the constraints kick in. So let's think about agency costs. And let's think about where the agency problems are going to be greatest. And the best way to think through this is think like a lender. Think about what kinds of companies you worry about your debt the most, because those are the companies where the agency costs are going to be great. So you have three choices here. You can lend to a technology company. You can lend to a large regulated public utility. Or you can lend to a real estate company. Which one are you going to be most uncomfortable lending to? You should to real estate, but it doesn't seem to faze people, right? They think big building, I'll lend more. Cover the building with gold, I'll lend even more, right? But with technology companies, what freaks you out? You have no idea what they're doing with the debt. They claim to be doing research, but how do you know? They might be hiring guys off the streets, putting white coats and they walk around the glass building, act busy, and you're looking outside, oh my God, they're doing research in there. You have no idea. Monitoring what a technology company does with their borrowing is incredibly difficult to do. So you know what the implication be? Holding all else constant, I would expect companies with intangible assets, assets that are difficult to monitor, to borrow less than companies that have physical assets. And one of the great things about lending to a regulated public utility is first, your revenues and earnings are pretty predictable because you have a monopoly. Second, they're restricted from going into new businesses because what terrifies lenders is you lend money to a company that you think is safe. Next thing you know, they're off into businesses you never thought they would get into. So think about your company again and ask yourself the question, if I were lending money to this company, would I feel uncomfortable? Because if your answer is yes, it's going to show up as higher cost of debt, higher agency costs, less debt. And the last piece of this puzzle is every time you borrow money, you give up some flexibility. The more you value future financing flexibility, the less you should borrow. You're saying, what does that mean, future financing flexibility? The more uncertain you are about what you need to invest in the future, the less you should borrow today. The more certain you become about your future investing needs, the more you can afford to borrow. Again, if you take regulated utilities, it's true that they have to spend money building new power plants, but they know for the next 10 years what they need to do. But if you're a technology company, you know you'll have to make big investments. But if I asked you in what, you say, I don't know, but the business keeps changing. I know I'll have to spend billions doing something. I just don't know what it is today. the more uncertain you become about your future needs for investing and financing, the less you should borrow today. So with that trade-off, let's look at what companies actually look at when they borrow money. This is from a survey, so take it for what it's worth, because surveys are not exactly the most reliable way to collect information. So CFOs of companies were asked what they thought about, when they looked at the different factors and whether they should borrow money, what they factored in. So starting at the top, that's what they said was the most important factor to them, and working down. They said the most important determinant of whether they borrowed money was maintaining financial flexibility. That was number one. Right below it was long-term survival. That's a bankruptcy cost. Okay? Third was having a predictable source of funds, which is you wanted to be able to do this year after year. You wanted to go to a source of capital that you could go back to. Then maximize stock price. So if you're thinking about objective in corporate finance being maximizing, it's in the middle of the ranks, not. And then at the bottom they say maintaining financial independence, maintaining high debt rating, and being like, I think this whole survey is a lie. If I were to rank them and looked at what companies actually do, I'd put the 7 on the top, where you borrow money to be like everybody else, but they can't admit to it, because then your job as a CFO becomes kind of shallow, right? I just look at what everybody else does. I do the same thing, so why do I need a CFO? I could just get one of those parrots that imitates things, a version of a parrot that says, okay, look at everybody's debt ratio, do the same thing. But that's what they claim to look at. So let's look at the trade-off. Tax benefits and added discipline on the plus side, expected bankruptcy cost, agency cost, and loss of flexibility on the minus side. So I'd like you to think about the company you picked. If you've forgotten the company, think about any other company. It doesn't matter. Okay? Put it through this trade-off. Because that to me is what drives how much, whether your company should have a lot of debt, average debt, or low debt. Because I tried it with my companies, for my 5 companies. With Deutsche, I'm not even going to try. Remember why debt to a bank is not a source of capital. So this debt-equity trade-off doesn't even make a difference. We'll talk about how to assess the capital structure for a bank. It's a very different game. But for non-financial service companies, look at the tax benefits. At least when I did this, Disney had the biggest tax benefits because of the US company. Bookscape as well. And the other countries, the tax rates were lower. One thing that is interesting about the Brazilian tax code is while the tax benefit of debt is high at 34%, the Brazilian tax code has this quirk that tries to give equity investors a tax break as well. And here's how they do it. They have this number that they publish in the tax code every year called interest on capital. Right now, for instance, this year it's 11.5%. And here's what you're allowed to do. You're allowed to take 11.5% of your book equity and claim it as it's a very half-assed way of trying to make things equal. But it basically means that if you have a book equity of 100 million, you're allowed to claim a tax savings of 11.5 million. What does it do? It reduces the marginal tax benefit of debt. Holding all else constant, that must mean you should borrow less money. Your added discipline, the benefit should be highest at Disney, where there is the managers own very little of the stock, and lowest at the other, at Tata Motors. It's a family group. You should be thinking about your best interest. You should need debt to do it. In terms of expected bankruptcy costs, the companies with volatile earnings, Baidu because it's a technology company, Tata Motors because it's a cyclical company, and Vale for commodity prices, should borrow less than companies with more predictable earnings. When you look at agency costs, I would be terrified lending to Baidu. Not only is it a technology company, it's a Chinese technology company. It's going to be incredibly opaque. For me to even look in and figure out what it's doing is going to be difficult. So it's going to be highest at Baidu. It's going to be smallest at companies with the physical assets, Vale and Tata Motors. Small consolation that I claim of mine, but at least it's something that I can see them doing. And finally, in terms of flexibility needs, the more mature a company, Disney and Tata Motors, the less you should care about flexibility. Younger companies should care more, they should borrow less. So it's a very simple trade-off, but it's a trade-off worth having. So I'm going to leave you with the question. I want you to think about the answer to the question, because we're going to start the next class with this. The Twilight Zone is back, in the new versions of it. I actually prefer Black Mirror now, which kind of makes it. Now, I used to be a Twilight Zone fan. But let's suppose because if you look at the trade-off here, right? You can think about the factors that play out, the tax benefits, but I want you to take your company and play out these the benefits and the costs, see what you come up with. And then ask yourself a Twilight Zone question. And the Twilight Zone question I'm going to ask you is, let's suppose tomorrow you woke up in a world, and here's what was true. Nobody paid taxes, so this is like Italy. Managers put stockholder interests first. They do what's right. No firm ever goes bankrupt in this world. I told you the Twilight Zone episode. Equity investors don't lie. So when they go to the bank to borrow money, they tell you exactly what they're going to do. And firms know their future financing needs with certainty. I want you to take this Twilight Zone world you're in, take it through the trade-off and tell me how much companies should borrow in this, because when we start on Wednesday, we're going to look at that because it's corporate finance's most famous theorem. We're very quickly going to extract it without ever having to derive it. But think about what the right mix of debt and equity is in a world with no taxes, no default risk, and no agency issues. I will see you after the quiz on Wednesday, but make sure you go to the right room, please.
So I have a confession to make. I've never went back and looked at my quiz because I was super depressed after I was just looking through it when I was revising for the next quiz, and I realized there were a couple of points, and maybe I don't care about the quiz. It's just mostly for my peace of mind, but going into the next one. So do you finish with me right now? I think it was just like grading things. So I did calculate the equity stream correctly. I understand that the method was wrong because I did the error.
One point is in this period.
Yes.
What are you doing here to get to the screen? What is the number? So read me what's in the thing.
0.51%, which is the equity risk premium.
But why is it the same for Thailand and Vietnam?
Because I did an overall equity risk premium.
So you can't do that.
I know my method was incorrect because I should have taken the common risk-free rate in US dollars.
No, but I'm saying even if you got the right risk-free rate, let's suppose you got the risk-free rate. The cost of equity for Thailand should be very different, because Vietnam is a much riskier country. They can't have the same risk rate. You can't take the composite average and make it the cost of equity for each. So you'd have to use Thailand's risk premium and Vietnam's risk premium if you're going to compute a weighted average. And so the point I took off was for the fact that you took a weighted average and the cost of both. I'll give you a half point.
I realized I was making some error here, and the other one was over here. I think this was just a calculation error. The method was right.
So basically, I'll give you 1 point.
Yeah.
So just email me.
Okay, thanks.
Hey, how are you?
I'm Matt, by the way. I don't think we had to meet you before. So you sent us an email about following up with you on the case numbers. I pretty much, we took a look at it and we broke down all the differences. There's about 11 of them.
So you took the time to actually write down the 11 differences here?
Yeah, that's the main ones. There's probably another.
So summarize them for me.
Yeah, sure. So the biggest thing is that there's some things that were just wrong, some things that were just off, and some things that were different incentives.
Yeah.
The biggest ones I would say are probably these two. So the first one is a CapEx calculation. We had an issue in our sheet where we had double counted CapEx.
Okay.
So we counted it in operating income, which dropped it down. For ours, you noticed that there was this huge negative cash flow in the first year,
Right.
and that's because of that. That just carried through all of the numbers. Which
The actual capex is 200, so you're showing 400 in the first year?
No. We counted it as a negative in operating income, so we had a negative operating income expense.
Okay.
And then
So
we
the
also added capex at the
So your
bottom.
capex is an operating income and then capex is
Yes,
cash. Okay.
yes. So it popped up in
Okay.
both. So it dropped down that first cash flow time. Another thing we did is we overly adjusted the restaurant betas. This one is totally my fault. When we calculated out the debt to equity ratio, we actually added in the value of operating leases to the market value of debt to create a new pseudo debt to equity ratio.
Right.
And then we calculated a new marginal tax rate based off of the fact that some of the operating leases you don't get the tax benefit from it. So we actually dropped
Why do you not get the tax benefit from leases?
from leases.
You'll get the same tax
From
benefit.
then I'm totally wrong on this because like I actually was thinking.
No, leases get you exactly. In fact, the entire
you're
lease
right.
payment is
Yeah,
tax
because
deductible, right?
the entire thing
All
is
you do is
tax.
break it out. So the
Yeah.
tax, there's really no
So
tax
there
difference.
should be no tax difference. So then.